So hi for everyone who just showed up, welcome. Feel free to introduce yourself in the chat. Make sure to write to all panelists and attendees. And then you can say who you are, where you're joining from, maybe something you want to learn. Okay, so I'm going to go ahead and while you guys are doing that and introducing yourselves, I'm going to go ahead and start just doing a few announcements. So welcome to this webinar. The webinar is titled Unlocking Investments for Water Entrepreneurship. This webinar is the 12th in our Think Big, Think Impact webinar series, which was part of a project sponsored by EIT Climate-KIC and Financial Centers for Sustainability. My name is Erin Duddy, and I'm the Online and Next Gen Program Lead at the Center for Sustainable Finance and Private Wealth, and it's really great to have you joining us for this webinar today. So I'm your moderator and also today your tech person, so if you have any issues with tech, you're welcome to reach out to me directly, and I'll do my best to help you. But I'm going to go ahead and share my screen to talk about a few technical things. So for those of you who might not have used Zoom before, but or maybe you haven't been aware of this feature, so the bottom bar, the toolbar, you'll see the chat function, which you can open up and use to chat with either us or us and the other attendees. And you'll also see the Q&A function, which you can use to submit questions. And specifically on the chat, there's this option to write to all, well, the default is all panelists, and we would recommend that you change this to all panelists and attendees. And then the other attendees can see your message. Just ending the slideshow. Okay, and the other thing is, so we'll be taking questions throughout the webinar and we'll be answering them at the end. So you're welcome to submit your questions through the Q&A function, and you're also able to upvote questions. So you can look at other people's questions, and then I think you can like it, and then depending on the likes, we might answer the most popular questions, or the most, the ones that most people are curious about. So feel free to use that function. And so with that, I'd love to introduce our speakers. First, we have Paul Gustensen, and he's the director of WASH at the Stone Family Foundation. Paul joined the foundation as the director of WASH in October 2015 and brings over 15 years of experience in the global water and sanitation sector. Paul's experience to date has bridged both rural and urban programming, and his strength is connecting people, ideas, and finance in a strategic way. Next, we have Taeun Kwon, and she's the Blended Finance Research Lead at CSP, where she conducts industry and academic research on how to effectively finance impact. She's also responsible for running training programs in blended finance and impact investing for donors. And finally, we have Caroline Truong. She's the Water Entrepreneurship Program Manager at CSP, and she explores innovative financing approaches for water entrepreneurs and runs the related activities. Carolyn has experience in working in the field of sustainable development, international cooperation, and entrepreneurship building, particularly in the water and sanitation sector. And she holds an MA in Economics and International Affairs from the University of St. Gallen. So now that the administrative bit is behind us, we have an exciting program for you today. We're going to start with Taeun, who will be introducing the project that she and Carolyn are working on. And then Carolyn will introduce a few innovative financing instruments. And finally, we'll hear about a real-world case study from Paul. So I will go ahead and hand it over to you, Taeun.
Thank you. Let me try to share my screen. All right, I think it works. Right, okay. So let me start with the webinar, Unlocking Investments for Water Entrepreneurship. That's the title of our project. And well, since Erin did all the work, I can dive right into the project introduction. So when I first started this project, And I think it would be good to start there. I also thought, why water? Why does water matter so much? And I was looking for inspirational quotes in the vast landscape of the internet and actually found this one that struck me. It says, "Thousands have lived without love, not one without water." And yet we still talk a lot about love and not necessarily a lot about water. But then we all agree that water is a super critical thing that we need in our lives. I mean, I brush my teeth, I drank water. I hope you guys also take a shower despite being stuck at home once in a while. And this is unfortunately not a luxury that everyone can share. I think I also mentioned it in a video clip on LinkedIn, but there are a lot of water-related issues in this world. So only 1 out of 4 people, for instance, have access to clean and safe drinking water. This means if you're in a family, imagine one of your children can't drink clean water, one of your parents can't drink clean water, or not even half of the population actually has access to safe sanitation. And if you look at conflict regions that are quite fragile, for example, the Middle East, you see an immediate correlation between a stable source of water and the amount of conflict there is in the region. So there is a critical problem there. And the problem is that the public also has a limit to how much it can provide. But fortunately for us, there are water enterprises and a lot of entrepreneurs out there that come up with innovative solutions through technology, through business models. It's really great to see their work, but they only have this teeny tiny problem called access to capital, minor issue. And the research project that we're trying to conduct is, okay, well, how do we then bring this flow of capital to these water enterprises because they face these challenges of accessing capital since they are, first of all, located in difficult regions, so investors don't like that. But also water is a public good, which means that usually you think of the public sector responsible for it. And that adds a layer of complication regarding regulation and so on and so forth. And then because it's a public good, there's also a relatively low willingness to pay, which means that as an enterprise, you're also struggling to be profitable. And this is why instead of traditional debt and equity, you also need a whole range of new innovative instruments. And in this project, we look at those instruments and try to see, okay, depending on the water enterprise, in which kind of context can this instrument be suitable and effective. So I wanted to introduce the 3 big clusters when we're talking about innovative financing instruments. And the first cluster is quasi-equity, which is not unique to the impact area. You can hear a lot of these terms also thrown around in the venture scene. So SAFE, short for Simple Agreement for Future Equity, revenue-based loans. It's also called alternative exits these days, and it's trending in the entrepreneurship scene. Convertible notes, mezzanine, venture debt, preferred equity. I mean, all of these terms are relatively familiar to any venture capitalist, for instance. But the reason why these are interesting is because they're quite customized to what the entrepreneurs need and can be used in an effective way that is friendly to the entrepreneur, which is why they are also interesting for social enterprises to look at. The second cluster is blended finance, and blended finance is the buzzword in the development world right now, for, well, good or bad reasons. But anyway, it's basically the concept where you blend public and private capital in the way that public capital joins in the transaction and tries to de-risk a lot of these seemingly risky investments through providing first loss capital or guarantees and so on and so forth, so that even more private capital could enter the transaction. So you have more capital for hopefully more impact. So that's the concept of blended finance. And the third cluster we're exploring is result-based finance. And result-based finance, just like the name would tell you, is you're financing for results. And traditionally, it comes from the public side, the public sector with development or aid, where they wanted to pay exactly for success or result or impact. And that's where the idea comes from. And unlike the other two clusters, result-based finance requires an outcome funder who's willing to pay for the impact, because the end beneficiary is either too poor to pay it for themselves, or the willingness, again, is not super high. So typically health, education, and of course the water sector is quite suitable for result-based financing instruments. And today we're going to explore revenue-based finance and impact bond more in detail. And I will just disappear into the background and let my wonderful colleague Carolyn take over. Oh, just a quick disclaimer. I mean, all of these things that we're talking about are relatively new, and even in development or in the impact investing scene, this is new. So in case you are not familiar or you don't understand, feel free to ask away, because probably somebody else in this room is wondering about the same thing.
I hope you can see my screen. Can you?
Yes, we can.
Okay, perfect. All right. Also, welcome from my side, and thank you, Taeun, for the wonderful introduction. So before we turn to the real world cases, we want to discuss these two instruments in more detail. So the first one is the impact bond. The impact bond has been initially introduced as a way to increase effectiveness of government spending. So it's not a bond in a traditional sense, but according to the definition, it's a results-based financing mechanism whereby private investors provide capital for the delivery of social services and are repaid if contractually predefined outcomes are achieved. So in other words, there's a private investor that's usually an impact investor that provides upfront capital to the service provider. In this example, it could be a water service operator. If the water service operator is able to achieve the pre-agreed outcome targets, say increased access to safe and affordable drinking water, the outcome funder then repays the investor with the principal plus an additional return. The outcome funder can be a government entity or a third party, for example, a foundation or the World Bank. In order to make sure that the impact has been created, an independent organization then verifies if the outcome targets have been actually met. So why is an impact bond, or why can an impact bond make sense? So the impact bond puts the outcome front and center. So we no longer just build water points, but we want to make sure that they are actually used and also maintained over a longer period. So the impact bond incentivizes the service provider to deliver those outcomes and provides flexibility and room for innovation by not constraining them to a certain type of input or activity. Impact bonds are also beneficial for investors who will be compensated for the risk they take. And the outcome funder also fulfills its mandate in a more effective way. So what does an impact bond mean if you are an investor or a water enterprise? So, one of the main benefits of investing in an impact bond is that an investor can help find a viable solution to pressing social issues. It can also allow the investor to invest in a more socially responsible way and also possibly create fundamental impact. Another benefit is that the investor can increase collaboration with various stakeholders and strengthen also public-private partnerships. However, an impact bond can be quite complex because of the number of actors involved, and therefore there is a high coordination effort necessary. One drawback that we identified is that the investor has to take a higher risk. So he provides the full capital upfront, but might possibly receive neither the principal nor the return back. The enterprise, on the other hand, can profit from an impact bond because there are lower financial risk for the enterprise. So there's no fixed amount of interest that the enterprise has to pay every month. It allows for autonomy and flexibility. After the enterprise receives the capital from the investor, the enterprise is quite free to choose how to achieve the results, and there's a lot of room for innovation. There's no dilution of ownership. And the fact that impact needs to be carefully measured and verified leads to accountability and transparency. However, at the same time, tracking and reporting on the results increases the administrative costs for the enterprise. Within our project, we also are looking at what are the main requirements for water enterprises to be eligible for impact bonds. So one of the factors are that the enterprise needs to be beyond seed stage. It has to have a proven business model that needs capital to scale, and the operation has to be streamlined, and the enterprise has to be clear about their costs. And of course, it has to have a potential to deliver impact as well. So let's turn to the next instrument, which is quite different from the impact bond. It's the revenue-based finance loan. It's defined as a quasi-equity financing instrument where periodic repayments are based on a percentage of the company's future revenues up to a predetermined return on the investment, also called multiple. So the revenue-based finance loan allows the enterprise to raise capital from an investor. The investor, on the other hand, receives oh no, sorry for that. I'm too far.
That's okay.
1 second.
Happens.
Okay, there we are. So the investor receives a percentage of the revenue, say around 5% of the company's future revenue. So the investor receives regular revenue shares until a certain pre-agreed amount, which can range between 2 to 5 times the original amount invested. However, these revenue shares can vary a lot depending on the company. For example, if the revenues are low in 1 month, the investor will get lower payments, and the overall repayment time can be extended. For this reason, a revenue-based finance loan can be a quite interesting model for water service providers because of the seasonal nature of their operation. So they usually have low revenues in the rainy season and higher revenues in the dry season. So what are the implications for the investor? The investor can, so the investor has a lot of flexibility because the structure of a revenue-based finance loan is quite simple. It offers flexibility because it can be structured as a way to fit the interests of both the investor as well as the enterprise. There's no conflict over the valuation of the enterprise, and both the enterprise and investor have the incentive to increase revenues. Another advantage of a revenue-based finance loan is that the loan starts to repay far sooner because payments are periodic and not dependent on an exit, as in traditional equity deals. The investor faces, however, lower risk due to these early returns, and therefore usually faces a constraint on the amount of return he receives. As I mentioned before, the repayment period can be unclear because the revenues fluctuate, but usually they are 3 to 4 years, and which is shorter than in a case of an equity. Revenue-based finance loan can be very interesting for an enterprise because there's no dilution of ownership, as in the impact bond, and there is a low financial burden. The enterprise doesn't have to pay fixed monthly interest, nor does it have to have collateral. As I mentioned before, businesses that face seasonal variations in income, this revenue-based finance loan can be a good solution. And it is flexible in regards of timeline. However, in times the enterprise is producing profits, there is no excess revenue left to invest in future growth because of the interest payments the enterprise has to pay. So the enterprise has an incentive and an interest to repay the loan as soon as possible. Again, we've been looking at different requirements the enterprise has to fulfill in order to be eligible for a revenue-based finance loan. That can, in contrast to the impact bond, the enterprise can be rather low, early stage, but it does have to have a revenue, as the name already applies. And ideally, it also has a plan to grow and grow the revenues in the future. And preferably, there's also a strong gross margin in order to accommodate the loan payments. The credit history, however, is less important for an investor, but it has to show a solid business plan. All right, that's already it from my side. So I'm happy to dive deeper into these instruments, and Paul will introduce us to the impact bond in Cambodia and the revenue financing facility.
Thanks, Carolyn. I guess we can stop the screen share, right?
Yeah.
Yeah, talk like normal people without the screen. So Paul, thanks again for making time. And yeah, I thought it would be nice if you could introduce actually the Stone Family Foundation for a bit, and why actually you decided to focus on market-based solutions particularly.
Yeah, sure. Thanks very much for the introduction, and yeah, very interesting presentation to kick us off. Yeah, so my name is Paul Gustensen. I'm the director of WASH at the Stone Family Foundation. We're a UK-based foundation that is a grant maker, but we also act as an impact investor. And yeah, we've been active in the water and sanitation sector for over the last 15 years, and in the last 5, we've really focused in on enterprise development and the role that market-based solutions can play in delivering better services. We're focused on that because, you know, the sector is beset by operational and financial sustainability issues, and also a sort of culture of not really treating people, you know, in the target markets as customers, treating them very passively as beneficiaries of support. And I think, you know, the founder and the family behind the foundation, and also the team that works there at the foundation, very much believes that, you know, people are customers, people are buying services, people have wants and needs, and you know, if you provide somebody with a service at the right price point and in the way that they want to use it, then, you know, I guess our hypothesis is that that could be much more sustainable than the sort of charitable, standard charitable model. Now, one thing I'd like to stress is that, you know, we don't see market-based solutions as being the panacea for all ills. You know, they are relevant in certain contexts and certain markets and for certain parts of the population. But when we look at some of the challenges that cities in Africa and Asia are facing around water quality or access to sewage, the reality is 95% of a city could be facing an issue of water quality, and, you know, upwards of the same could be also suffering from poor levels of on-site sanitation. And so the enterprise models that we work with are very much focused on addressing that sort of 95% of the population. So and our hope and expectation is that that will lead to them being financially and operationally much more sustainable. So.
Yeah, no, that sounds super interesting. Perhaps you could also elaborate on the 2 instruments and how you guys used it, starting with the impact bond.
Sure. Yeah. So we launched the Rural Sanitation in Cambodia Development Impact Bond last year on World Toilet Day, and you know, it's the first DIB in the water and sanitation sector, which we're very proud of. You know, for us, the headline figures are: it's a $10 million DIB, which means $10 million of outcomes payments will be provided by USAID, who is the outcome provider. The foundation is playing the role, if you look back at Caroline's diagram earlier, we're playing the role as the impact investor, and we will commit up to a maximum of $3.5 million to deliver that, to deliver the program. Now, you know, as a foundation and an impact investor sitting with the headquarters in the UK, we don't actually do anything necessarily. We are working with our implementing partner, IDE, who are on the ground delivering a program. And you know, the DIB is very much a culmination of, I think it's about 8 or 9 years now of our own engagement in the rural sanitation sector in Cambodia, but also supporting IDE's work. In total, we've committed around $11 million of grant funding prior to the DIB. And that has enabled us to have a deep understanding of the market, understanding of the opportunities. And it also, I think, really facilitated the decision around why we chose the DIB as being the right mechanism to help IDE.
So before we go into the last bit, who was actually the initiator of this entire impact bond transaction?
So we initiated it because, and I suppose I'll give you the background. IDE have been doing rural programming in Cambodia since 2010, 2011, and very successful rural sanitation marketing. So this is kind of promoting both the supply and demand side of sanitation provision in rural Cambodia, where traditionally coverage rates have been very low. And what they'd found after that time of programming was they'd got to sort of 70% coverage, and you know, they were starting to come down the backside of the bell curve. They was finding each effort at selling more latrines was getting harder and harder. And so, you know, really from their perspective, they needed a program pivot to be able to really deliver universal services or universal access to as many people as possible, which is the SDG goal. And, you know, what we also know is that communal sanitation, the public health benefits of communal sanitation don't really kick in until you get to 85–90% coverage in a community. So, so there was a need for the program to pivot. At the same time, the foundation, you know, as a foundation, we're in a very fortunate position. We can deploy capital in lots of different ways. We can deploy grants, debt, equity. We can make it concessional, and so, you know, we have that flexibility. we also know that our role is to take risk. Our role is to support innovation. Our role is to drive forward and take the risk that, say, a bilateral or a development finance institution can't take. And so what we were finding with our support to IDE was we were playing that role less and less. We were supporting a program that was kind of very, very large, very, very clearly articulated, and was delivering lots of social impact, which was great, but it wasn't really fitting our risk profile. So, given those two things, we reflected upon some of the payment by results mechanisms that we could see in the sector, and the development impact bonds were emerging as an idea. And we looked across our portfolio, and we looked at IDE's work and thought, are there the elements here of what we think is important for something like a DIB or another payment by results mechanism? And so with that question in mind, we approached IDE to say, look, you have a very successful program here that understands its costs. You're operating at scale already. It's not as risky as it used to be. And as a foundation, we want to take more risk, not less risk. You also have a program pivot that you need to make. And how do we incentivize, how do we create a structure that incentivizes you to make that pivot? But also we had a very clear goal in mind, which was we want to get coverage rates in villages to as close to 100% as we possibly can, because that's when really the public health benefit of sanitation will kick in. And so with all those things combined, we did a feasibility study, we asked that question, and we came out with the answer of yes, actually a DIB would be a useful structure because it aligns incentives across the various stakeholders. It will deliver a very clear goal that we all are aligned around, and we can all play to our comparative advantages. So the foundation taking risk, playing the role as the investor, IDE having the capital that they can use to pivot the program and innovate, because they're focused on that one goal, as opposed to, as you said earlier, Caroline, the inputs that are needed to get to that, which is where you can get bogged down in more traditional grant making. And then, for USAID as the outcome payer, they value the outcome, they understand the program, and they're very happy to sort of pay on the basis that those outcomes are achieved.
I see. Actually, I have a question. Why you structured it as an impact bond and not as a, for instance, pay for success scheme? That would have been more straightforward.
I think quite possibly, yes. I think what we wanted to do is to test out the concept of a development impact bond. At the time, 2-3 years ago, a lot of people in the sector were trying to do they were doing some detailed analysis around, could a DIB work in the water and sanitation sector? And I think one of the hypotheses we have is, yes, in the right context, a DIB could work. But I think, that was a key question in the feasibility study. Like, why would we do a DIB over another payment by results mechanism? And I guess more fundamentally, why would we do a payment by results mechanism? And I think for us, it enables us to play the role that we want to play, which is as an impact investor in this context, and in a role where we're taking considerable risk, because we're taking all the financial risk on the program. That plays to our strengths, because that's what we're willing and able to do. So
I see. And I guess also one of the questions usually is that the reward of the impact usually goes to the investor. And my understanding is also that you try to align more the incentives for IDE as well.
Yeah, so what we want to try and do as a foundation is demonstrate that impact investing in sanitation is possible. And for us, we're a foundation that is that runs off an endowment, and that is invested, and that's generating returns. And so in our impact investment portfolio, we're very much focused. If you think about the spectrum of social and financial return, we very much sort of sit more on the social return side. So really, we really strongly value the social impact of this and the achievement of the 100% coverage, or the ODF, the open defecation free status, which each village will have. The financial return is important. It is important to us. As an investor, we want our principal back, because then we can recycle that investment into other opportunities. But it's not necessarily the only goal that we had in investing in the DIB. And again, we're in a fortunate position where we can make those decisions. And so what we wanted to also do is to share some of the return that will be generated back with IDE, in a sense, to incentivize them, but also to recognize their critical role in delivering the program, because ultimately we're an investor, we're not an implementer. And it's through their hard work on the ground in Cambodia that the social impact will be generated. So we felt it only fair that we shared that return with them. And actually, the return is actually weighted slightly more heavily towards them than us actually. So
since we also have a question on it, could you also share what the terms were for this DIB?
Terms in what sense?
Christoph, if you could elaborate, terms in what sense?
I mean, I can talk through the structure. So it's a 4-year DIB, $10 million worth of outcomes. You know, the commitment from us is up to 3.5 million. At the moment, we've dispersed 2.5 million. There's a very detailed financial model and implementation model that sits behind this. And what's happening is every 6 months, we are submitting a claim to USAID and funds are being recycled back to us and we pass them back to ITE. So that minimizes the amount of capital that we've had to put at risk up front, although we have committed up to $3.5 million because that's what the financial model suggests is required to deliver the program. In terms of return, it's about a 5% IRR, which means at the end we could generate up to $1 million of return, which will then be split between us and IDE. So you know, and as an impact investor, those funds will be returned back to invest in other enterprises, other programs across the portfolio that we manage to deliver more social impact, which is what really motivates us. So.
I assume also the question was a little bit about, you know, against what outcomes or outputs or the measurements.
So the core outcome that sits, there is one outcome that the whole DIB is focused on, which is villages making an open defecation free claim, which is a recognized government standard in Cambodia around essentially everyone in the community using a safely managed latrine. So that is an outcome of a fairly intensive 12-month process of assessing everyone in the village, working through checking everybody has access to a latrine, checking everyone's using it, and various other elements to it. This DIB very much is aligned to the national action plan that the government of Cambodia has, which is to drive forward the number of villages that make ODF claims. And so the target within the DIB is 1,600 villages across 6 provinces in Cambodia that will make these claims. So.
It's actually neat. I love how, because one of the points or criticism towards impact bond is also the whole verification cost. And I guess it's really neat that you use sort of the government standard, that they do the verification for you, that no additional cost is spent on that.
Yeah, and I think you're going to come on to touch upon some of the critiques of DIBs. And again, I would stress that these are not the panacea to all ills, you know, and I think the question that anyone needs to ask themselves around A, payment by results mechanisms, and B, DIBs is why would you do that? Why would you use that mechanism in that context? And I think that's really important because, you know, the critique is they're very complex, you know, there is all these additional layers, it's very hard. And I think one of the things that we've managed with this DIB is sort of beauty with simplicity. There is one investor, there is one implementer, and there is one outcomes payer. That is not the same for a lot of DIBs. In a lot of DIBs, there are 2 or 3 investors, there's 2 or 3 implementers, and there's 3 or 4 outcomes payers. And understandably, then there's a lot of complexity with that, and there's a lot of transaction costs associated with that. And in those contexts, you need an independent verifier, which can be quite costly. You know, let's not shy away from that. But in this DIB, you know, the quality of IDE's programming and their data enabled us not to need to have an independent verifier. That both enables, you know, it's a quicker process, but it also means we have a lot more trust and confidence within the DIB itself. And, you know, through the due diligence process, we sat down as all 3 stakeholders and we went through all of the data that IDE has, and we're all very comfortable with what they're generating, and, you know, they have first-class data sets. So we didn't feel there was the need for an independent verifier.
Yeah, I see. Really interesting. But enough about the impact bond. Let's also try to get a bit more detail on the revenue-based finance instrument that you use, on the facility. Perhaps you can elaborate a little bit about what the facility looks like.
Yeah, absolutely. So again, it's focused in Cambodia because the foundation has been very active in Cambodia over the last 10 years. So we understand the market reasonably well as anyone can when you're not based there, I think. And so the Cambodia Revenue Finance Facility is a revenue-backed financing facility in partnership with a local bank in Cambodia. It's focused on private water operators. So in Cambodia, there are 300 private water operators who have licenses 20-year licenses to deliver clean water services to rural populations. It's a fairly established sector, and there's a reasonable amount of finance that flows into the sector. But what we could see was local bank lending to these operators was relatively low. The collateral requirements are quite high in Cambodia, to sort of 200–300% of any loan value, always hard land titles. And so, that was preventing a lot of the private water operators from continuing to invest in the growth of their businesses. And often that growth, that lack of investment in growth, came at the expense of connecting peripheral villages in their license area, which is often where the poorest sections of society were living. So, as a foundation, we're very interested in the achievement of SDG 6 and universal access in water and sanitation. And so we tried to, we approached this challenge from the perspective of thinking, well, how could we incentivize these operators to connect to those those peripheral villages where perhaps more marginalized people are living, and enable the operators both to have higher social impact, but also generate more returns and become more financially sustainable. And so, we explored the concept of revenue-backed financing, and what we've ended up enabling or setting up is a facility in partnership with a local bank, where we now have 15 operators, investments to 15 operators, and with a total commitment of about $6 million. And we have aspirations to grow that to sort of 10 in the next 12 to 18 months. And so as you touched upon earlier, Caroline, the structure of it is we lend, or the bank lends against a multiple, and the range of the multiples is about 1.4 to 1.6, depending on the investment. And we work out a sort of a payback period, but it all depends on performance. And the way that the operator pays the bank back is based on, as a percentage of their revenues. Now, as Caroline says earlier, the seasonality of water businesses makes this type of structure very useful, we think, because every 6 months in Cambodia, you have a very clear dry season and a very clear wet season. And so as revenues rise and fall, so do the repayments. Because what we were seeing with some of the operators is, in the wet season, when their revenues were dropping, they actually couldn't afford to service the fixed interest debt that they'd taken. And it was actually becoming quite punitive for a lot of them. And so what this enables them to do is to pay us back as a percentage. So in the good times, we in real value terms, we get a higher amount of repayments. But in the wet season, or if they have a bad period, it drops down in line with the revenues that are generated. So it's very flexible financing, and actually the operators are incentivized to pay us back quicker, because the quicker and they're incentivized to improve their business, because the quicker they generate more revenues, the quicker they pay us back. Now, alongside the finance, we've also provided working capital loans to encourage them to make more connections to more households. So more connections equals more revenue equals quicker paying us back. So we're trying to incentivize the operator to kind of really grow the business, have the social impact, strengthen themselves financially, and make themselves more sustainable. But ultimately, the end result is that they pay back the loan quicker. So that's kind of the basic structure, if you like.
Thank you. Oh yeah. So this facility, it's 2 years old now, right?
Yes. Yes. We've had 2 years worth of investments. Yeah.
Yeah. So what were some of the key learnings or key challenges on the way that you faced?
I think again, coming back to the role that the foundation can play and our partnership with the bank, is that we can be incredibly flexible. And so that's a real asset in these types of structures, I think. I think one of the things is we've really focused on the affordability of these loans, and there are very detailed cash flow analyses and business plans that sit behind the investments. I think one of the key things for us as well is that we place a lot of emphasis on the quality of the management, both across all the portfolios that we run, but in particular this one. And so we spend a lot of time going to visit the operators in Cambodia in very rural areas, spending time with them, trying to work out, trying to build that level of trust. And that's two-way, trust is earned. But I think that's a key thing for us, is making sure that, the operators that you're working with have the ambition to have the social impact that they say they will. They have the quality of the team around them to be able to deliver that, and just that the working relationship is gonna be conducive to success. So I think also we're fortunate that we found a partner in Cambodia that's very competent and able to support us with some of the early stage due diligence. And that's really enabled us to continue at a time when we can't travel to Cambodia. It's enabled us to keep that facility going and keep making investments. So, but I think, ultimately it's about affordability and flexibility, and being focused on the end goal that you're trying to achieve, which ultimately for us is social impact. But let's not downplay it. Clearly, we want the return on our investment, and we want the finance to be repaid. So.
Would you say that that if, for instance, as an investor, you want to join a facility like yours, that it requires the same flexibility that a foundation like yours have, or what's the kind of investor profile for which this would be interesting?
I mean, that's a good question. I think any investment in the water and sanitation sector people need to come in with their eyes wide open, in the sense that it can be a bit of a challenging sector in some senses. Enterprise development in our sector is not the same as, say, in the home solar market or the microgrid market in Africa, for example, which I know is really developed. And so expectations of return need to be carefully managed. I think what we're trying to demonstrate as an impact investor is that in the right context and with the right levels of patience and flexibility, you can achieve that. But also it's really important to value the social impact that these investments can have. So I think both the DIB and the Cambodia Revenue Finance Facility are an effort by us to demonstrate how impact investment could work in the water and sanitation sector. And to stress again, these types of investments are not the panacea to all of the ills of the sector. They will work in certain contexts. And but what I would say is, having been in the sector for 15 years, I think what I'm seeing now more and more is more and more opportunities. And I think even in my time at the foundation, the investments we're making now, we have an impact investment portfolio of almost $14 million now, whereas when I joined the foundation, it was about $2 million. So we've really been able to grow that, and that's a reflection of the maturity of the sector, but also the flexibility that you can bring to that.
Yeah, that's quite incredible. So I don't want to monopolize all the questions. So in case people have questions, please put them in the chat. But otherwise, I'll keep going. Well, I mean, one of the questions I did have is that, once the DIB ends and once the facility closes, what is the plan for continuity?
So IDE have a very extensive program in Cambodia, and I think one thing to stress is the DIB is one part of their rural sanitation programming. So I think the expectation is they will continue to work in rural sanitation in Cambodia. For the foundation, I'm not sure currently what our strategy is long term. I think ultimately we have been slowly exiting rural sanitation in Cambodia, and in some senses the DIB is our kind of part of that exit strategy. Other elements of that have been, we've been supporting the government to develop their national action plan and deliver on that. We've supported other organizations who are also delivering excellent work in different areas and using different approaches. And also we had a partnership with the World Bank for a couple of years, which was really focused on trying to embed some of the development impact that's been had over the last 10 years and really support the government to take the leadership. Now ultimately with a DIB, we have impact bonds here in the UK where the government is the outcome payer. And I think ultimately that is the end goal, where the government would play more and more of a role as the outcome payer. And we recognize that at the moment, that isn't the case in this DIB, and that lends itself to a critique of, well, what are you really proving here? And I think what we're trying to demonstrate is how the structure would work. And in an ideal world, the next DIB in Cambodia would be where the outcome payer would be the government. So the government is very engaged in it, and they're certainly up to speed with how it's going. Now, we need to find a way in which to try and bring them on board potentially as the next outcome payer, which I think is ultimately the goal.
I see. And then for the revenue-based facility, you have a partnership with the local bank. So by now, I guess that your local bank then has some sort of expertise in this lending structure.
Yeah, to a degree, yes, they do. And I think what it's enabled them to do is to understand the water operators as a potential market for them and their lending. So they haven't traditionally done significant amounts of SME lending in Cambodia. They have tended to focus on other sectors. So I think it's been a good process, and we've got a good partnership with them. We're very aligned with the management there, and that's really helped us get the facility off the ground. So I think longer term, what we want to try and think about is how might we actually set up a bit of a fund structure potentially, and maybe even to consider how to expand it to become a regional facility. But these things take time to structure, and particularly at a time when we can't travel to the region, makes it a bit harder to really make progress on the thinking around that.
Yeah, no, super interesting. I mean, especially because this can, I mean, any sector that has seasonality, like agriculture, for instance, this can be applied. So there's just a lot of potential for this. I find it very interesting. But I think we're slowly reaching our time, right, Erin?
Yeah, right. I think we had planned just at the end, which we are almost at, that we would have more of a call to action, and that kind of about, if somebody's interested in investing in water, what can they do?
What more could they do? Well, I mean, as a starting point, I'd be very happy to pick up the conversation with any of the participants on the group. I think it's a very rewarding sector. The social impact of water and sanitation is significant. It underpins almost every development SDG or development goal that any country has. And I think I think that's been even more relevant in these COVID times. So I think don't let the complexity of the sector sort of put you off in a sense. I think we have come a long way in a short space of time, and I think for me, what keeps me interested and motivated in this role is kind of all this feeling that we're always on the crest of a wave. And I think, but the reality is the sector needs more finance, it needs more impact investors, it needs more flexible finance. I think that the World Bank has some crazy statistic that needs over 100 billion a year to deliver the SDGs. Now, that's going to have to come from a variety of sources, and so I guess what we're trying to show is that you can bring those different types of finance, and if you're creative around how you structure the finance, you can have return and you can have social impact. And those two things don't have to be mutually exclusive, but it does take patience and sort of reasonable appetite for risk. And I think as a foundation, we're well placed to do that, and we're happy to do that. In fact, my board pushes us more and more on why we're not taking enough risk, which is kind of an odd position to be in sometimes with a board. But we welcome that, because that's our role. We understand that's the role of philanthropy and impact investing, is to take risk and to showcase. So,
yes, certainly. Taeun and Carolyn, would you be able to add anything from your side?
Well, I would add that it's been super interesting to have you, Paul, talk about the transaction, because it's one thing knowing the theory and the construct of it all, but then really seeing something live is different. And I think that's actually why I find impact investing also as a researcher so fascinating, that you have, of course, the theory and the conceptual frameworks, but then seeing it live is completely different. So yeah, thanks again for all the details and your sharing.
No, it's a pleasure. Thank you for inviting me along. And a lot of the information that we've shared is on our website, so do feel free to jump on there. There's downloadable resources. We'll be issuing a couple of papers that explain the structure of the Cambodia Revenue Finance Facility a bit more, and also the DIB in the new year. So, but yeah, please feel free to reach out. Very happy to chat through our experiences in more detail as needed. So, but thank you for the invitation and the opportunity.
Yeah, and also, we're just midway through our project, and there are many, many other instruments that we're also covering in the project. So in case anybody has interest in the water sector, in investing, and just wondering, what kind of instruments can I use or would be appropriate to use, then please stay tuned until, is it April? Is it that close? Damn, okay. Anyway, so yeah, please stay tuned until April.
There's more to come. Okay, so then with that, everyone, thanks for your interest today and your participation in our webinar. And thank you all for your contributions today. And thank you, Paul, for coming on as our guest speaker. And if you in the audience are interested in the work that CSP does, we'll share a link to our webpage. We will also share a link to the Stone Family Foundation webpage in the follow-up email that will come tomorrow. And we'll also share a link in our chat to our YouTube channel where you'll find the past webinars that have been recorded. And then in about a week, you'll find this recording if you want to share it. And so this was our last webinar for the year. And we'll be back. So I have nothing to advertise until next year, but we'll be back next year with a new program. And we look forward to seeing you then. And we hope you have a great rest of your day, and we will see you later. Happy holidays.
Happy holidays.
Thank you. Bye-bye.
Bye.
Thank you.